Joining me is Ed O'Gorman. He's the CEO and CIO of River Wealth Advisors. Ed, welcome.
Good morning. Thank you for having me.
Of course. So what are you going to be watching most closely as trading gets underway for this week?
I think this week is going to be interesting to see if we have, follow on from last week and, really software under pressure, the AI rotation we've been watching really for the past couple of months. We really want to see how that unfolds this week.
All right, and we're also in the heart of earnings season, of course. More than 100 S&P 500 companies reported last week. What's your assessment of the earnings that have come out so far?
It's been a really strong reporting cycle for the fourth quarter. Looks like earnings are going to come in around 13% improvement. It'll be the fifth straight quarter of double-digit earnings growth for the S&P 500. Looking at significant outperformance of expectations, both in earnings and in revenue. So, so far so good.
All right, and we also heard from many of the six of the seven Mag 7 companies. What do you think it tells us about AI spending and AI moving forward?
Just tremendous spending coming our way. 100% increase in spending at Google, 50% increase at Amazon. Just tremendous spending. Looking at over 600 billion of spending this year, up significantly from last year. So clearly, more of spending to come, more investment in AI to come, and a lot more to, really unfold and try to understand, what is the ROI long term on these investments.
All right, and what are sectors or industry groups are you favoring right now?
I think with this rotation, looking at more value-oriented areas of the market, areas that were underinvested last year, we're seeing really good returns and earnings numbers out of industrials, interest in materials, even utilities. So really just kind of looking away from those positions and sectors that have had abnormally large returns over the past couple of years and looking for opportunities elsewhere.
And we also have jobs and inflation data coming out in the following days. What are you anticipating?
Well, with the market's anticipating about a 70,000 increase in jobs on Wednesday. That's on the heels of a 50,000 increase. There's really been mixed numbers coming out, significant layoffs going back almost to 2009 levels with challenger numbers last week. Jolts were disappointing. So, to see what we have this week in terms of employment numbers, but certainly a softening labor market. CPI could be a big market mover if numbers disappoint relative to expectations. Really kind of looking for 2.5% numbers this week, but again, that's something the market's going to watch closely.
All right, and the Fed, of course, kept interest rates unchanged in January, and President Trump nominated Kevin Warsh as the next Fed chair. What impact, Ed, do you think it could have on potential rate cuts in 2026?
Well, I think he was a surprising pick. There was some satisfaction, at least from the market's perspective. It doesn't seem like the market is too concerned with the pick. Relatively stable performance after the announcement. But he tends to be a hawkish leaning guy over the past. And so it'll be interesting to see where he is now sort of marrying easing short-term rates with shrinking a balance sheet as an offset. So, expect things to be a bit different, but it's a board, right? So he has fellow board members that he needs to sway his way and really build consensus. So we'll see how that plays out.
All right. And where do you see opportunities for investors in the fixed income space?
I think, fixed income, again, a great year last year, really tremendous performance on not only coupon, but also rates coming down. This year, I think, is going to be a bit more subdued. It's one of those markets where sometimes fixed income investors sort of try to reach into pockets of the market searching for yield. I think that can be a dangerous move. Right now, I think, corporate investment grade provides a nice yield pickup. Certainly adding some international exposure, emerging market debt provides some additional yield. But looking at high yield and really junk right now, really not that appealing. Historically tight yields there, just not a lot of value for taking the risk. So we're playing it fairly safe here at River Wealth, and sticking with the investment grade piece of the market.
All right, thank you, Ed O'Gorman, CEO and CIO of River Wealth Advisors.
Thank you.